All right, folks, welcome back to the Property Couch podcast. And today we are very excited to bring you this content because we are interviewing a very special guest today, Ben, aren't we?
Yes, mate. The one and only Tim Lawless from CoreLogic, one of the best in the marketplace.
He is one of the best, Ben. And we're going to talk about a report that they released recently on the long game, 30 years of housing values. I think you're going to be super surprised by some of the insights that you're going to get here, Ben. But I believe you made a prediction.
Yeah, a little tip. Tim's got a tip for us in terms of what's going to happen in the market in early 2023. Stay tuned.
Oh, you got to check that out, folks. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast and welcome back to you too, Ben. How are you?
Oh, mate, I am terrific. Definitely one of the favourite parts of my week is this podcast, so I can't wait to get into it.
I know, we get to riff it. It's wonderful. Hey, we got a very special guest today, so stick around for that. Before we get there, Ben, we have snuck out a couple little bonus episodes, Ben.
Yeah, we have, Bryce. So a couple of things we've been doing. So episode number 3 of Talking Tax with Julia Hartman. So we obviously produced that for our customers and then we put it onto the podcast, which is awesome. So really happy that we're sharing that to our full community. And interestingly, Bryce, we did an update for our financial planning clients and our general clients in that space around the equity market. So I interviewed Michael Savvy, who's our Chief Investment Officer and also a partner in the financial planning business. So we got such good feedback from that we decided to put it on. So it's actually a video presentation, but we're taking the audio out. So
the audio.
And so they have been posted earlier. So if you haven't already caught them, you may have caught them already if you're keeping up to date. But obviously, if you haven't, you can also check them out. They're online now as well through.
And if you haven't checked it out, folks, there's an update to the car analogy that we used through the pandemic. And Stiggy comes up to me, Ben. She goes, "Ooh, you got to hear the update to the analogy." So,
what did she say? She says it's better than yours, better than your analogy.
No, well, I borrowed the analogy from Michael in the first place, so it's just an updated of it. So, mate, I'm a curator. I'm a curator of information, mate. So, I thought you were going to kneecap me then, but I'm onto you.
No, I don't kneecap. I love what you do. You make things.
Well, we've got no footy to hang it on each other with it in these awkward months between no footy and.
We've made a conscious decision not to talk trade talk. We've obviously seen all the trades, but everyone's going to urge you get. We promise to only talk about footy in the footy season, except for if the girls are winning, of course, because there's girls' footy season.
The whole time you're saying that, I'm thinking, I bet you, he's taken 30 seconds to say we're not going to talk about that, and then all of a sudden you had to drop a little Collingwood in as well. So
very. So footy's still live. I'm still going to talk about the girls.
Very good, Ben. I love it. You're true to form. Hey, my Mindset Minute theme today, Ben. Interesting, right? One of our team, Joel, sends me this little note. And when someone comes into the business, Ben, they go online and they make it known they want to meet with us and they go and submit their details into the More platform. And there's a question of, what is it that you want to come for? Have a listen to this. It's funny. So what do I want? I want to get an idea of cost to get me out of the procrastination zone and into my first investment property. I think I told Joel in 2016, at the time of reporting, Ben, it's 2022. So that's, if I hadn't done anything in 12 months, I'd hand the keys to my future over to him. I'm late. I thought.
Only 6 years.
And we're going to talk about, in our interview today with Tim, we're going to talk about CoreLogic. So in 2016, they got a report. The combined capitals for houses, roughly, Ben, don't quote me absolutely, was around the 7 to 750 mark. And now, as we speak, 928. So if you're wondering how expensive procrastination is, Ben, that is a very rough back of napkin on how expensive procrastination is. So
is that an example of leaving money on the table, Bryce?
Leaving money on the table.
Folks,
we say you're going to pay in one of four ways, Ben. And one of those 4 ways is through procrastination. We've just put a dollar figure on. If you're interested in the other ways, we might put a link to that video so you can see the 4 ways that a property investor will pay. But I thought that was interesting, Ben. So my Mindset Minute theme today is, are you in the procrastination zone? Is that something that you might be able to take heed from? Because if this person had have actually done something, even if they had handed the keys to Joel 12 months later from 2016 to 2017, they would be infinitely is not true, but significantly better off.
Imagine that equity, they can then recycle that equity. Anyway, we won't go there.
Now, Ben, that was a strategic placement for the conversation that we're going to have today with our very special guest, Tim Lawless, who heads up CoreLogic's Australian Research Division. So we had a wonderful conversation with Tim earlier today. So let's cut to the conversation right now. All right, Ben, we've got a very special guest today. We are chatting with Tim Lawless, no stranger to the Property Couch. He's one of Australia's leading property market analysts and commentators. He was the founder of CoreLogic's Australian Research Division, formerly known as RP Data. Tim's expertise is sought by governments and regulators, as well as corporations in the property, banking and financial sectors. As Research Director, Tim heads up a team of analysts in Australia and New Zealand, reports on property market conditions and the interplay between economic and demographic forces. Ben, I said he's a returning guest. Welcome back to the Property Couch, Tim.
Hey, Bryce.
And Bryce, you just missed one person there, Bryce, and that's me. He's my resource as well. Yeah. So he's not just helping governments or anyone else. I'm always...
Oh, yes. Exactly. He's a direct line into Kingsley at Pickup. But, hey, mate, welcome back to the couch. It's been a little while, but you are a man in demand, I would say, these days, with property markets being always the number one barbecue topic. But does that get doubled down in a huge hurry when it's on the downside?
Thanks, mate. It's great to be back. Yeah, a lot of water under the bridge since last time I was on the show. But yeah, I think it probably has doubled down, to be honest. I agree. It's staple conversation at the Australian barbecue is what's happening with Australian housing prices. But now that's obviously pivoted to, well, how far have prices fallen since this monumental upswing we've just been through? And that's probably where a lot of the context is missing from the public debate is we're seeing housing values falling now, sure, quite rapidly, in fact, but it comes after quite the spectacular upswing in most cities and regions around the country.
Well, for most people, they've seen fluctuations in property markets over the last sort of 10, 15 years. But for a lot of people, over 1 million people, they're experiencing interest rate rises for the first time. So we're going to dive into that with you really shortly. But despite the fact we've had you on before, we haven't had this conversation with you before, Tim, and it's around our mission here on the Property Couch to get all of our listeners having conversations over their dinner table or their breakfast table around money. And part of that is to really get to understand people like yourself, what that was like. So can you give us a little insight into the Lawless household? Growing up as a youngster, was your family one of those ones that had conversations around money, or did you have to learn via osmosis or other ways?
Yeah, if you have a spectrum of financial transparency in our household where 1 is nothing and 10 is complete transparency, I was probably down below 1. So yeah, absolutely, we didn't talk about household finances when I was a lad. And in fact, I remember a distinct conversation, or even it wasn't a conversation, it was overhearing mum and dad talking when I was finishing grade 12 of all things this was 1989. And they were talking about the fact that interest rates were really high, but they were nearly paid off the debt on the home and wouldn't be too bad. And I kind of remember thinking to myself, we actually have debt. Geez, that doesn't sound very good. But knowing what I know now, obviously, we're in a very good financial position back then, especially considering how high interest rates were when I was finishing grade 12 in 89. And I've really made a conscious decision with my family, with my wife, Amanda, and my 2 kids. We talk about our own finances and budgets and, housing debt all the time across the table. I think it's really important that kids understand, have some financial acumen, especially as they move into going to uni and their own budgeting and savings and hopefully saving for a home down the track. I think it's important to start that really early.
What's some of the fruit of that? For you mentioned that the kids are starting to save for deposit. Can you see some tangible fruit from having those conversations if you contrast that back to the minus scale for you when you were growing up?
Not yet. I don't think there's any tangible evidence yet. My kids are still relatively young. Finley's 16, Madeline's 14. So, but I'd like to think they've got a good grounding, that they understand the basics at the very least, and probably most importantly, they're not afraid to ask about things like indebtedness, or how much do things cost, or how much of our income is going towards things like school fees and food and our mortgage. So it's probably just more the transparency and the openness and the frankness. As a little bit of a tangent, I remember when I was first working at RP Data, this is way back in the late 1990s, when it was still a privately owned company owned by the founder, Ray Catlin. We had this project where obviously we were taking photos of every house around the country, which was quite unique. This is like, decades before Google Street View. And it really brought RP Data into the mainstream. And a lot of people at that time were absolutely gobsmacked. They could get on this platform and see what their neighbors paid for their house. Whereas these days, I'd like to think that RP Data has really improved the transparency on, what's probably the most important asset anyone's ever going to own. And knowing what people paid for a property is really important to understand what the current values are and what our financial positions are.
So just on that, Tim, have you prepared yourself for the inevitable, you can't be a prophet in your own village? So at some point in time, your kids are going to get to an age where they will need to seek some advice around property, and you will try and give them some advice, and they'll give you that look of, what would you know, Dad? Which would be the most ironic look that you'd probably get.
Yeah, no doubt around the corner. Everything moves so quickly these days. So, but hopefully I'm in a position to give my kids some advice and they listen to it. But I think the best advice I ever got was just do it. Don't overthink it and get into the marketplace. And it's forced savings in many ways. I remember when I bought my first home, I really had to scrimp and save and pull everything together just to get into the marketplace. This was back in 2002, I think it was. And I'm so happy I did. But for the few years after that, my nightlife consisted of going down to the local bowls club at Maruka. And Amanda and I would use our spare change. I'd have a rum and coke and she'd have a shardy. And that was the most of what we had left to spend on any sort of social life. It was well and truly worth it.
Now, let's round out the money story growing up. Just quickly tell us, when you started earning your first income, sort of what job was it? And how did you set up your banking and your money management solutions? Was it trial and error? Or did you have a third-party resource that you got organised with? How did that all play out?
No, I think it was just trial and error, to be honest. And I was probably a pretty poor financial manager up until I met my wife, Amanda, and she was a banker. So she put me on the straight and narrow and helped me consolidate some of the debt that I had as well. So yeah, I think I was quite immature when it came to managing my finances and ensuring that I had some good spending habits and so forth. So yeah, an internal gratitude to my wife for just putting us onto a much more responsible path.
Oh, I love a good mentor. And if you're listening to this, Amanda, congratulations. Now you've got one over Tim. Yes. So let's turn our attentions now to the current market, where it sits. We saw the CoreLogic results come out for the September month. Can you just talk to us about the big themes that you saw inside those results, Tim?
Yeah, well, the main theme was obviously housing values are still falling. They have been in most cities since rates started to rise. In fact, Sydney and Melbourne peaked a lot earlier. Sydney, on our data, peaked back in January, and values are down about 9% since that peak. In Melbourne, they peaked back in February and they've fallen by about 5.6%. Most other markets are playing catch up, although Adelaide and Perth still really quite resilient. We're seeing values falling there, but you probably better describe it as a flattening out. In September, Adelaide was only down 0.2% over the month, Perth down by 0.4%. But probably the big news, I think, on our September data was the rate of decline started to ease off in most regions. So, for example, Sydney, where we've seen housing values fall the most and the fastest, in August, we reported a 2.3% drop. In September, values were down 1.8%. Melbourne's seen 2 months now where the rate of growth has improved a little bit. Brisbane improved a little bit as well. So, Interesting to see that at the same month that we saw auction clearance rates improve a little bit, sentiment rose, the flow of new listings coming into the markets remained extraordinarily low, that we've also seen a subtle improvement in how fast values are falling. Whether or not this is a trend that's going to establish itself is still unknown. We're obviously still going to be seeing interest rates rising, but you'd have to say that the 25 basis point hike we saw for October is also good news. Never thought I'd be saying higher interest rates is good news, but it's better than a 50 basis point hike. So I wouldn't be surprised if that flows through to maybe even a further improvement in sentiment, but time will tell.
Did the 25 basis points catch you on the hop? Because most people were expecting 50 points. I remember at the time of the announcement, I was scrolling through news feeds and no one had anything. So I can see all these editors scrambling in the background to get their backup plan to release their blogs because they weren't planning for it as well. Were you one of the few that predicted that, or did you?
No, I can't lay claim to that. There's a few well-known economists who did get it right. Yeah. Gareth Aird, good example. There's a few people got it right, absolutely, and absolute respect to people forecasting the cash rate or anything at the moment. There's so much uncertainty. How much of it's an element of luck, who knows? But hopefully this is the start of a new trend where we're not going to be seeing any more of these really chunky 50 basis point rises. And the fact that we're seeing a monthly inflation measure now as well, maybe starting to hint already that inflation's starting to wind down, at least in trend terms.
Now, Tim, we saw that you were quoted actually in the Fin Review talking about the potential bottom being early 2023. So I just want to make sure that journalist quoted you correctly. Is that sort of where you're thinking we might find the bottom?
That was an accurate quote. Absolutely. It's pretty rare to be misquoted these days. I did say that, and I still stand by it. And that's predicated on the fact that we're starting to see the mainstream view that the cash rate or interest rates will probably find a ceiling through the first quarter of next year as well. And it's long been our view that once interest rates stabilize, we'll probably see housing prices stabilize as well. The financial markets still looking quite bearish, even though they've adjusted back a little bit. Financial markets are still pricing in a peak in the cash rate around the middle of next year. It looks like the consensus view now is probably a peak in the cash rate first quarter, and I'm betting that will also herald a stabilization in housing prices.
Yeah, Tim, if I can just build on that, I mean, in the long-term report that we're going to get to, and that's obviously the main focus of today, what Bryce and I were talking about before we came to air is the last couple of cycles, especially in Melbourne and Sydney, the turnaround was quite evident in terms of the sentiment in the market. If we're going out on weekends to auctions, it just clicked on and it sort of just clicked off, right? And it's happened the last couple of cycles. Now, both of those sort of cycles have been led by cheaper money. So, sort of thinking about interest rates coming down off that. What are your thoughts on this particular cycle, given where the cash rate will probably land and we'll see sort of retail rates in that 5 to 6% range? Do you see a further sort of quick, sort of confidence shift, or is this one's going to be a little bit slower for longer?
My guess is it's probably going to be a little bit more gradual this time around, but it really depends on policy. So some of the reasons why we saw quite rapid turnarounds through previous cycles have been, well, for example, 2019, if it wasn't for COVID, that was really the middle of 2019 was the beginning of this most recent growth cycle. And that was heralded by three things: the federal election, providing some certainty and removal of taxation reform with regards to property. But it also saw rates coming down and APRA loosening up some of their policies around serviceability buffers. And that was pretty instant. We saw housing market moving pretty swiftly into quite a strong growth phase. And then COVID happened and that got interrupted and then it got amplified. Prior to that, 2012, it was interest rates coming down and quite a pretty decent improvement in affordability as well. Looking forward to next year, it's probably going to be the case that interest rates stay on hold rather than coming down straight away. And I'm saying that because I think the inflation target for the RBA, which is 2 to 3%, that'll take some time to achieve. So it really depends on what happens with monetary policy this time around. I'd be very surprised to see, a fiscal support lifeline being thrown to the housing market at a time when inflation remains high. So for that reason, I think watch for rates starting to come down. That'll probably herald the start of a new growth cycle, but that's probably not likely until maybe late next year, if not into 2024.
So Tim, just to round that off for then me, obviously APRA put in a 3% buffer. If we think back to when they introduced that, cash rate was 185. We're now at a cash rate of 260. What's your view on their decision? And obviously the Council of Financial Regulators must have known that this softening in cash rate was about to happen, because we've heard basically zero from APRA in regards to that 3% buffer, which is really causing a lot of friction in the refinance market and obviously in the new purchasing market as well.
Yeah, well, that adjustment to the buffer, which was back in October of 2021, raising from 2.5 percentage points to 3 percentage points, we're already getting pretty close to that buffer being, surpassed in terms of how far interest rates have risen from their low point. So arguably that was a responsible move from APRA, and considering the emergency lows of the cash rate at the time and the emergency lows of mortgage rates. But you'd have to think, now that interest rates are normalizing so quickly, there's a 3 percentage buffer. Is it still warranted? Chances are we're not going to see another 2.5 or even a 3 percentage point increase from where we are at the moment. So I'd have to guess that this is something that's being discussed behind closed doors within the Council of Financial Regulators, that potentially that serviceability buffer could be relaxed at some stage. That's exactly what APRA did back in, I think it was June or July of 2019. They reduced the serviceability buffer to reflect the fact that interest rates were likely to stay lower for longer. And arguably, as interest rates reach a ceiling over this current cycle, you'd have to think that there'll be similar discussions being had.
Tim, Queensland land tax. A couple of weeks ago, you're a Queensland resident. Your government did a backflip on the Queensland tax. We spoke to the Premier last week about that. Premier of New South Wales, that was. Can you tell us what the forecasting was looking like for you, in particular for Queensland, with that in play? And then did you form a view on it as a policy, and has it changed your forecast for particularly Southeast Queensland now that has been shelved?
Yeah, great news. It's been shelved, and absolutely our view was firmly that it was another disincentive, a fairly significant disincentive to investors to introduce more rental stock to the marketplace at a time when the rental market desperately needs more supply. It was an absolute cash grab, and it was poorly thought out. There was no consultation. There was no strategic thinking about the implications, the long term, even the medium term implications of what it might mean for rental supply. So I think we could even see in our own data. Pre-COVID, we generally see about 25% of listings coming to the market were thought to be investment owned. There was a bit of an upswing through COVID, but it held quite high, particularly in Queensland, as a lot more investors were offloading their stock into the marketplace, which obviously is one of the reasons why rental vacancy rates are as low as what they are. So now that it's been backflipped, or the government's backflipped and they've taken this off the table, well, that's great news. You'd have to think that's going to be a positive for investment activity, at least over the medium term. Investors are generally motivated by capital gains, but you'd have to argue that a lot of the rental reforms that we've seen and this crazy land tax policy that the Queensland government had announced, along with premiums on mortgage rates for investors are around 30 basis points, all these things just add up to disincentivizing investment in the marketplace. So now that one of them is gone, at least in Queensland, I think that's a good thing. And I wouldn't be surprised if investors are focusing on Southeast Queensland in particular. It's a market that probably has pretty decent medium to long-term capital gains prospects. Yields are higher than Sydney and Melbourne by some margin. Rental markets are extraordinarily tight, and the demographic trends are really positive. So yeah, I think my forecast or my outlook for investment in Queensland post backflip is much more positive than what it was had this policy been implemented.
And it kind of gives us confirmation that we should have little faith in our politicians, that they are going to have well thought through policies that have some strategic nous to them, given that the unintended consequences of the negative gearing reforms at the previous election campaign was not well thought through. And then to your point that you just said then, around this current policy not being well thought through of the unintended consequences, it doesn't leave us with a lot of faith that any future proposed policies will be well thought through, or more importantly, people like yourself and Ben in positions where there are some feedback around what those consequences might be will be consulted. So I guess it's more of an observation than a question to you.
It just highlights also the importance of groups like PIPA, Nicola McDougall, just really taking the charge and highlighting some of the risks associated with these sort of policies. So without that sort of noise in the marketplace, you'd have to argue that we may not have seen this policy taken off the table.
100% agree.
Yes, concur 100%. So, Tim, what we wanted to do is in late August, you released a paper and it was all about the long game. So talking about 30 years of housing values. As soon as I read it, I said, we're getting Tim back on. We've got to organise to get Tim back on because I want to have a conversation about this. So firstly, congratulations on the insights in there. It's obviously reinforces a lot of the sort of conversations that we've been having with our community for a long time, and it sort of helps people educate that. But just sort of give us a position of why you decided to put this paper out. We'll put it in the show notes for everyone. We'll give a link to it because it is actually, essential reading for anyone who needs to understand how to play the long game. But let's just sort of talk through what motivated you to do it, and then basically what were sort of some of the big takeaway findings that you had in there.
Yeah, thanks. It's I think the motivation simply came back to, remember, we released this in August. So it was a few months into the rate hiking cycle, and I guess the focus of housing market commentary was very much on the short-term downwards movements, which is fair enough. I mean, even through the upswing, but the focus is on the short-term upwards movements as well. So that's just the news cycle. But it was worthwhile. I think it was worthwhile just reiterating that most homeowners don't own their property over a short term. It's a long-term asset hold. It's even just thinking about your stamp duty, your transactional costs and so forth, your buying and selling costs. It's not a liquid asset. So it's a long-term play, which not everyone holds their property for 30 years. Granted, the typical hold period in Australia is a little bit less than 10 years. But even that, it's worthwhile just looking at the housing trends through the decades and what they've done. So it was just a good opportunity to reiterate the long-term trends in a housing market and maybe dispel a few myths and remind people that the short-term movements, sure, they're important. They fuel our barbecue conversation, and everybody's interested to know what the worth of their housing is, especially considering more than 50% of household wealth is in housing. You can understand it. I think it was just a firm reminder that housing trends over the medium to long term are much more important.
Yeah, I think it's a great report. I double down on what Ben just said about it being essential reading. There was a line towards the front of the report that reads, most homeowners aren't directly impacted by changing values. At the peak of the latest growth cycle, approximately 617,300 homes were sold across Australia, but that represents only 6.3% of dwellings turning over in a year. So your conclusion in that statement was, therefore, a more direct impact from short-term changes in housing market conditions are felt by the small proportion of households that are considering a property purchase or sale. From year to year, only 4 to 6% of properties are transacted. That, I reckon people need to let that sink in and let that land, because there is a lot of noise and there is a lot of sentiment change. And there's a wonderful graph in that report to get people a sense of all of these headlines that would have made the front page of the newspaper all the way through the 30-year cycle, which is fascinating reading. But I think for anyone who's got some form of anxiety or forgetting that the market is correcting a little bit from an incredible run, just that point alone to remember, to your point in the report, Tim, most people are not directly affected by it.
Yeah, that's exactly right. And, a 6% plus turnover rate is actually extraordinarily high. That was pretty much it. We went through a record high level of transactional activity through the end of 2021. Coming through the last downturn, only about 3.5% of dwellings turned over through, early 2019 was that low point. So that is even a pretty big estimate of turnover. But it's just really important, I think, sure, there are some indirect mechanisms where short-term changes in property value will affect things like equity and your ability to leverage the value of your home into other assets and other investments and so forth. but you don't really see the impact until you sell.
Now, Tim, the report talks about obviously that dwelling value, that typical dwelling value that doesn't exist. So it's obviously a general report. But just to for the benefit of the community, we sort of talk about in the period of I'm trying to think here from 1992 to 2002, we saw a 77% increase in value in the home value index. In the second decade, the middle decade from 2002 to 2012, we saw a 59% increase. And in the final decade, we basically saw up until obviously 2022, we saw another 72% increase. Now, I thought about those 3 decades and I thought, why is the middle decade only at 59? Do you have any sort of views on that? The only thing I could come up with something, but I want to hear your views first.
Yeah, so there are a bunch of reasons, and those were national numbers you're talking about.
Yes.
So you've got to remember that the national reading is very heavily weighted towards Sydney and Melbourne, and that's where the weakness, particularly Sydney, was evident in that middle decade between 2002 and 2012. So Sydney, for example, was up about 32% through that middle decade, Melbourne by 69%, whereas go to somewhere like Perth, up 103%, or nearly 104%. Hobart was up 93%, Brisbane up 74%, Adelaide 72%. So that was really a story of Sydney, to a lesser extent Melbourne, weighing down the average. And the other thing that really is important to remember about that middle decade was it was very much part of the mining boom. So Sydney obviously didn't really partake in the mining boom as much as like a Perth, where prices doubled. And the other really big reason, or the most important factor, probably comes back to that period between May of 2002 and March of 2008, which was a period where interest rates were rising. They rose from about 4.25%, this is the cash rate, 4.25%, up to 7.25%. So quite a substantial lift in interest rates through that time. And then it met with the GFC, obviously. So yeah, that's probably the best explanation for that middle decade being weaker. Is it was more a story about Sydney weighing things down rather than any sort of strange quirk in the numbers.
See, interestingly, I went and then overlaid that long-term cash rate. So I did basically have a look at that overlay, and it's really clear that you can see, obviously in the early 1990s, we had a very, very high cash rate, that rocketing down. So there's that clear inversion of value return during that time. During the middle decade, even though you had that correction, there was a nice sort of pattern of really the cash rate over that decade didn't move from 4.25 to 4.25. So it went up and down during that time. And then finally, obviously, we saw a cash rate coming down to 0.1. And then hence we've got this extra. So from my point of view, at a very, very macro level, we talk about cycles within cycles, markets within markets, and we can show evidence of when the cash rate's going up, that values are going up in some markets and so forth. But just that broader macro view over a 30-year period, there's no doubt the amount of free cash and borrowing power and income does play a role in terms of moving values higher and lower.
Yeah, and there's another lesson in there as well. I think the interest rate environment's probably critical, but I mean, the fact that Perth completely defied that and saw values rocket more than double over that middle decade just highlights, the impact from an extraordinarily strong economy and very low labor unemployment rates, and just the impact of the commodity cycle on a market like Perth. It was extraordinary.
Yeah, I mean, that is something that Bryce and I have been considering about our investment theses and how we look after clients. And we've been doing some work on that in terms of looking at gross state production and looking at productivity within a particular, economic centre and the housing within that economic centre. And when you start thinking about that in sort of 40 to 50 year terms, it's quite fascinating in terms of what you see in those results as well. And that's not just here in Australia, but also overseas. I mean, one of the things that I've been looking at Singapore, and I've been looking at Australia and the US and Malaysia as the sort of analysis I've been doing since 1960 onwards. And it is quite fascinating in terms of where you see all of this economic productivity, and you see the land values of those major centres over that time, there is a strong correlation between that productivity and that economy, that localized economy, in terms of how that falls into land values over time.
And the inability of supply to meet a demand that surges so quickly as well. And that was the big part in WA was, that mining boom created a huge amount of demand, and there simply wasn't a supply response. So we saw housing prices rocket, and the supply response came really late. It was way too late, in fact, and that's one of the reasons why the Perth market underperformed over the following decade, like 2012 to 2022. Perth was down 8.9%. Regional WA was down 8.9%, and Perth was only up 14% over that last decade.
Yeah, I mean, it just also goes to show you that when you've got strong economic output, in the short term, demand will outstrip supply. You get this strong push of growth. The question then is it sustainable? I mean, if you can use really simple examples like a Broken Hill, for example, where it was a big mining centre back in the early turn of the 19th century, and, lots of jobs, lots of opportunity, lots of prosperity. You take that economic driver out of that town, and now it's a quasi-ghost town, right? And so you see that on the macro scale for Perth, mining boom, momentum, but and I think we're going back into that cycle. Perth, as a general market, is going to look pretty good over the next couple of years, in our opinion. But it is interesting to sort of say, if you can't keep that momentum, then ultimately, that sort of gross domestic production that you're going to see in those areas, it's going to show up in land values and prices over time.
Yeah, and I think in the case, I fully agree. Perth is looking very good to me in terms of its affordability. It's cheap. It's got extraordinary rental yields compared to the other cities, really tight rental markets. But that economy really needs to diversify. It's a bit of a one-trick pony, unfortunately, which does create some risk.
Yeah, definitely.
Well, to that point of economic activity, it'd be worth quoting the highest performing growth location over 30 years, Tim, for both the city and the regional market. I think the regional market might surprise.
Yeah, so over the 30-year period, just looking really broadly at the capitals and the region, so Melbourne was the best performing market, where we saw housing values increase by about 460% over that 30-year period. In annual terms, compounding annual terms, that was 5.9% per annum. So remember, to double your money every 10 years, you're looking for a compounding growth rate of 7.2%. So certainly didn't see prices doubling every decade, but that was the best performing market. And then, it's maybe a bit of a surprise. Regional Tassie took out the gong for the best regional market, up 361% in value over that full 30-year period. Moving from a really low base, which is probably one of the reasons why regional Tassie was so strong, but also, even just looking through the last growth cycle, regional Tassie has just absolutely boomed. It's cheap. It ticks the lifestyle box. And, for a lot of people who might be, climate change alarmists or whatever, regional Tassie really
like
is
Tasmania. The last bastion to cook.
Yep.
And so on the flip side of that, let's go to the lowest performing over those for the city and for the regions. I don't think the region is a surprise on this one, I might add.
Yeah, well, they're both in WA, and just the sheer volatility, even though Perth and regional WA, which were the lowest growth rates over the past 30 years, they saw spectacular growth periods during part of that. But the unfortunate reality is the volatility and the long-term weakness through the second part of that 30-year period has just completely eroded the long-term growth rate. So Perth values are up 303% over the past 30 years. That equates to about a 4.8% growth rate, and regional WA up 214, or about 3.9% per annum. So obviously there's a whole bunch of volatility and differences once you start to drill down below that capital city and broad regional market. So there are some better performers and worse performers, obviously, in the mix as well.
Tim, can you talk to our community who don't understand stats and research as well as you do about the level of the research at the SA3 level? So what that encompasses, just to give them a bit of a sense, because I guess what the findings in this report kind of confirm what Ben and I have been saying on the podcast for a long time, and what we've experienced in our own personal portfolios and our clients, that at a higher macro level, the headline statement of your report is folks, the property doesn't double every 10 years. We're proving it, right? But we're not buying a market. No one's buying Melbourne or no one's buying regional WA. They're actually buying a property in a suburb in a street. And so we've back tested a whole bunch of properties, and we can see that they've actually doubled even in the decades where at a macro level they're not. So I think understanding the level of macro that you have to go to be able to report at the level you do, so that people can go, I thought property did double every 10 years, or mine actually has, but the macro, it's kind of helpful for people to understand that asset selection is important. Not every property doubles in value. And when you aggregate it at the level that you have to, you take some of the outliers and the underperformers, and they come together to get you an overall result.
Yeah, that is so important. A good rule of thumb is the further down you drill geographically, the more volatility you'll see in the data, and that's natural volatility. It's not like the measures are broken or anything. It's once you go down to look at the stock market is another good example. Once you start looking at, say, an indexed fund, individual stock, your volatility is going to be extreme at the individual level, but not anywhere near as volatile at a portfolio level or an index level. So it's the same with housing. So a good example would be, we quite often publish our data at a capital city or a rest of state level, and then we'll drill it down to an SA4, and then an SA3, and then an SA2. So obviously at the capital city level, there's 8 capital cities and there's 7 rest of state regions. Well, ACT doesn't have a rest of state, so that's why there's 7. And then you go down to an SA4, there's, I think, roughly 180 SA4s and about 380 roughly SA3s, and it just gets larger and larger, kind of like a Russian doll. But once you start getting down to, say, the suburb level or the postcode level, you just need to make sure you've got a good sample size of observations, that you're not trying to measure statistics in a marketplace where the housing stock is too diverse. So we look for things like a standard deviation or a forecast standard deviation in the statistics themselves. So then when you take the volume, the forecast standard deviation, the number of valid evaluation estimates as well, it gives you something to filter on. And filtering out those areas that are too volatile to report on is a really important part of monitoring and reporting statistics. But also it's really important that that's transparent. There's no point filtering things out and not letting people know what you are or aren't including.
And the challenge you've got with that also, Tim, is that, like in Adelaide, for example, you can have like 150 houses, and that's a suburb, right? They've got some really tiny little suburbs there, and then you've got suburbs like Bundoora in the northern suburbs of Melbourne, and that's like the size of Texas. Do you know what I mean? And so there's no consistency in that count number, and so there's also inside those bigger suburbs, there is real variability when it comes to the different types of stock and the price ranges in those areas. So you can report on a quarterly basis or even a half yearly basis. And what you can find in that data is, hey, wait a minute, when you look at probably the most expensive streets by income and so forth, there's been no sales in that localized area, but there's been a lot of sales in other areas. And so the quarterly results shows that it's 15% down off its peaks. But in reality, coming back to the turnover of stock, given, it's only 6% or 5% year on year, you've got to try and then understand that nuance as well. And that's where you get that variability, isn't it?
Yeah, that's very true. That there are a lot more sophisticated methodologies now, like the hedonic regression index that we use, that try to overcome some of that compositional bias, is what you're talking about. The fact that you may be seeing transactional activity skewed towards, say, the first home buyer end of the market rather than upper end. So trying to break the market down into its underlying components or attributes is what the hedonic index does. I'm not saying it's perfect at doing that. I mean, housing inherently is an imperfect measurement. It's there's so much diversity. There's, as you say, there's sometimes a lack of observations as well, which is why measuring home values is not as straightforward as measuring something as easy as, say, equity markets, where you see every single transaction immediately, and it's very homogenous. You know exactly what's being traded. There's no differences in quality, for example.
So here's a perfect example, right? So we just heard from Tim that the number one market was Melbourne. Okay, so we've got Melbourne as the number one market, which over the 30-year time frame recorded a 459% increase. But when you get down to the SA3 level, and you look at the top performing SA3 market, that was Yarra inside Melbourne with a 779% increase. And so you can see even in that aspect of that variability, I mean, from 459%, I'll take the 779 over the 459 any day of the week.
Yeah, it was interesting. Just before this podcast, I did look at some of the smaller area data. I looked at council areas around the country just to see if there were any council areas on our index that had doubled in value every single decade. And there wasn't, by the way. But I thought, what if they say increased by 80%, at least 80% every single decade? And there were three council areas around the country that did double in value, rise by at least 80% through each of those 3 decades. And they were all in Melbourne, and they were all for houses. So it was Burundara, which includes markets like Toorak and so forth. Yep. There was the Mornington Peninsula, which has gone through an absolute boom through the most recent cycle. And then there was Yarra, all for detached houses rather than units. So yeah, just looking for some examples of where maybe there's some consistency in really high rates of growth. It looks like some of these, what you might describe as fairly high-end blue chip markets, where there's inherent scarcity value, really sort of stand out from other markets.
They really are popping, aren't they? I mean, it's really clear when you look at the top 20 capital cities, SA3 regions, Yarra, Melbourne City, Boroondara, Maribyrnong, Port Phillip, they are all inner city locations. And then you go to eastern suburbs of Sydney, you've got Canada Bay in Sydney, Strathfield. It's quite fascinating that we do see that. I mean, we all understand that really other regions or other centres are price takers of value compared to the city, because normally the cycle starts with, the volatility is in the highest end of the market where that has the biggest corrections, but it also potentially has the biggest runs, doesn't it?
That's exactly right. And over a long term, they tend to show much higher rates of capital gain. And I think this really reflects, as I mentioned a bit earlier on, the scarcity value of these suburbs. They're mostly well established. It's hard to fit more supply into them. They're generally quite expensive. So getting into the marketplaces, if you are getting a high percentage gain, it's off a fairly large capital base already. And the flip side, of course, is that the areas that are generally showing the lowest rates of growth tend to be markets that don't show those values. They don't have scarcity value. They don't have any, insulation for the amount of supply that can be introduced to the market, because there's still a lot of land left to be developed.
Yeah.
And it kind of proves our thesis too, Ben, that we've been talking about for 412 episodes now, that location does 80% of the heavy lifting, because this is actually showing that the location is doing an enormous amount of heavy lifting. And if you go down even in the top 20 in Melbourne, the 11th suburb, Ben, has done in dollar value change, not percentage, has done 1,999,017 in growth. That's the 11th suburb, but the fourth in percentage wise has done 925,000. So your bank dollars, not percentages. So it's important to realise that, sure, the percentage growth is good, but at the end of the day, the bank is going to look at how much money the property has grown in value, because that's what they'll release the equity for, whether or not you want to use it to buy something else or perhaps sell. So interesting to confirm that location does 80% of heavy lifting.
Yeah, and I think we need to put that in context for our community. Not everyone can turn around and go and buy the median house in Yarra. No. Or, the median house in, blue chip country in New South Wales. So it is horses for courses. I mean, is it Sorrel Dodgers Ferry in Hobart for houses that grew by 589% over that 30-year period. Now that's a cash gain of $586,000. So you're right. I mean, I'd still take that gain over a 456% or 496% gain. So we realise that, in all cases, it's the scarcity that Tim's talking about, and it's very hard for everyone to be able to afford to go in those areas. So please don't dismiss that as, okay, well, the show's over for us for capital growth. You can find capital growth, you can use demand and supply indicators, you can do all those types of things, but it does show you over that longer period of time that the evidence is suggesting that scarcity level and all of that value is eventually being baked into the land. And that comes from a combination of things. And if we all knew the perfect answer to that, we wouldn't be here today. It's still a social science. It's still not an exact science, as Tim talks to. So, so to me, Tim, it's a real clear indicator for me that yes, timing the market is important, but time in the market really does shine the light on basically any way in which you can create wealth over the long term.
Well, I think that's the whole nature of this long-term report we put out was exactly that. That if you're trying to time the marketplace, it's notoriously challenging, if not impossible. Trying to time your purchase at the moment to wait for the market to bottom out, you're not going to know it's bottomed out until after the fact anyway. But if you're going to be holding that asset for say upwards of 8 or 9 years, then chances are it's not going to make a huge amount of difference. It's really how long you hold that property for, and hopefully going through a few different phases of growth and different changes in the cycle.
Well, if you're playing for the long term, if you wait for it to bottom out, you might actually pay a lower price at a higher interest rate, and it could actually end up costing you more to hold the asset, but given the fact that you've got a 10, 20-year outlook anyway. There's a wonderful graph in here that I reckon everyone should have a look at, Tim. I'm sure you know it off the top, but it goes combined at capitals for houses and units, regions and houses and units. And it has a wonderful trend, overwhelmingly says that the trend is up. But then you highlight all of the events that happened along the way. And I want to just read out a couple. Back in 2002, mortgage rates gradually rise from 6.2% in April 2002 to 9.6% in August 2008. Then it goes on to say August 2009, RBA commences interest rate tightening, lifting the cash rate from 3 to 4.75% in December 10. So what we're experiencing now has happened in the past. And if you see that there was some corrections and that moves up, then at the top it says in 2016, roughly, APRA announces 10% speed limit on investment lending. Investors reach a record high proportion of mortgage activity at 46%. And APRA announces a 30% limit on interest-only loans. If you rewind back to those times, and we remember at the time, it was like, oh gosh, this has got a major impact. And we're having the same sorts of conversations that people are having now with the normalization of interest rates. And yet the graph overwhelmingly says, well, the trend is still up and there's been some volatility along the way. But if you had have actually still gone in at the time of that negative news, you'd still be much better off now than if you hadn't done anything.
Yeah, I think that's why we put all those signposts in there. The other reason was look at some of these major economic events, like maybe, the Asian financial crisis or the tech wreck, stuff like that. They didn't really have any impact on the housing market. In fact, in some cases, it was a positive trajectory in housing prices.
Right to housing.
Following, exactly. I think some of the sentiment just moved into a more of a safer asset class like housing. So it is phenomenal to look back through some of these signposts and looking at how the market reacted. The biggest reactions seem to be from things like monetary policy along with credit policy. The macro-prudential policies we saw being rolled out in 2014 or late 2014 and 2017, and then the Royal Commission, absolutely, that impacted the housing market because it limited credit supply. And then interest rates rising, of course, seem to have a much bigger impact, and interest rates falling on the other side. So, yeah, there's some things that impact more than others. That's for sure.
Tim, my final question for you for today is because I could talk to you all day. You know that I love you. In terms of the houses versus unit markets, and obviously regional markets and regional unit markets, they've obviously had a little bit of a tougher time of it coming off a lower base though. What's your sort of next 3 to 5 year view of the sort of unit market, given we're sort of coming out of the pandemic and we're sort of hopefully moving back to a more normalized society?
I'm pretty bullish on medium to high density, to be honest. That's quite a different perspective than what I've had previously. And the reason I think the unit market could be outperforming over the coming, say, 3 to 5 years simply comes back to supply. We've seen an absolute supply response for houses due to home builder through the pandemic, moving to record highs, but there hasn't been anything from units. When I say anything, it's pretty much held around average levels, particularly the high-rise sector, which has been below average. We've seen a bit of a response in townhomes. But with affordability likely to be remaining challenging, with rental markets remaining really tight, with potentially delivery of higher density supply being constrained by caution from lenders as well, my guess is we're probably moving into an undersupply in many of the major unit markets around the country. I'd still be a little bit cautious around some of the off-the-plan markets, and generally tend to prefer established personally. But I think there will be some opportunities in the unit market that could see that sector showing even a stronger performance than houses in some cases, despite my ongoing rhetoric around supply and the land value really drives growth. I think at least over the medium term, we could see that really favouring units for a little while.
I think they're really interesting thoughts because when you think about we obviously have a bias towards getting as much land as you possibly can, but using Melbourne as an example, last decade, you could buy a unit in the southeast of Melbourne, or for similar dollars, you could go across the bridge and buy a house to the inner west, right, and then gentrify. But because of the supply constraint being so low, water has actually found its own level across most of the cities, so that those arbitrage opportunities don't actually exist choosing between a unit and a house. It's kind of the house has dried up. So now if you're down to a spot where you go, well, I want to stay within my network and my family and my friends. So if I want to stay in that suburb, I've got to choose a different style of dwelling, which means smaller land components. So I'm interested in your thought. I think I personally think there's some merit in what you're saying because there's been underperformance for some time, but I just think the supply and demand conditions would suggest that. My final one for you, Tim, is the regions, the cities outgrew the regions. But if we were to forward project to 2032, so we dropped 92 out of it and we've got the 30 years, it's crystal ball stuff for you. But what do you think the region reading or index would have then? Because we've just had this massive, at the beginning of the decade, flight to the regions. You personally live in regional Queensland up there in Sunshine Coast. So do you think that that's just a beginning of the decade thing and there's some reselling on that? Have you got a view?
Yeah, I've definitely got a view. I'll be honest and say trying to speculate or forecast anything, a year out is hard, let alone 10 years. So with that as my qualifier, I think a lot of these regional commutable markets, Sunny Coast a good example, but also the Gold Coast, Newcastle, Wollongong, Geelong, Ballarat, any of these markets that are within, an hour and a half to 2 hour commuting time of the major capitals, I think have undergone a permanent structural change in their underlying demand profile. Just as people can work from home, I think that's got some amount of permanency to it. You don't want to be living too far away and still be commutable to some extent that you can do a couple of days a week. So I think these areas are really in the sweet spot at the moment, although you've got to say the affordability advantage they used to have has been eroded pretty heavily due to the fact that we've seen markets like, Noosa's up more than 50%, Gold Coast up more than 50%, Byron is up nearly 60% through this growth phase. So they're no longer really affordable, but I think the lifestyle elements and the commutability is livability and commutability, I think is probably the two prime things. You used to be able to throw affordability in there, but that's no longer the case. But I think those two other things will continue to see those markets remaining more popular post-COVID than they were pre-COVID, which means they probably will see some ongoing gains. Once you get beyond that, it's the areas that are not really commutable, they tend to operate more in their own economic spheres, be it based on mining or tourism or agriculture, and much less connected to the broader capital city cycles.
Well, there you have it, Tim. Thank you again. For our community to just understand this, Tim is a thought leader in our space, and we want to continue to keep thanking CoreLogic and also Michelle, who helps organise Tim's diary. It's just an absolute honour and pleasure to talk shop with you, Tim, and obviously, the beneficiary is our community in terms of getting an understanding of that. And to all of those people who are listening to this episode, please do yourself a favour and have a look at all of the content in which CoreLogic is providing out into the marketplace, because if you are a novice, if you are a beginner, you could do a lot worse, I mean a hell of a lot worse, than listening to everything that Tim has to say and everything that sort of is put in the data. Like at the end of the day, the insights are data-driven, and, again, it's about the thought leadership around, understanding what that data means. And Tim is obviously at the peak of his powers as one of the best researchers in the country. So Tim, we thank you very much for coming on the show.
It's always an absolute pleasure, Ben. And Bryce, thanks again for inviting me on, and I'll see you next time, eh?
Yeah, no, absolutely. I'll second that on behalf of our community. Thanks for that. And folks, we are definitely going to put the long game 30 years of housing value into our show notes. We 100% encourage you to go and have a look at that. If for the very least, you just go and have a look at this chart that shows you all the, to quote Tim, the road bumps along the way. It's just incredibly insightful. So thank you, Tim. It won't be the last time we get you on, and we appreciate everything you're doing, as Ben said.
Thanks again.
Ben, how quickly does time fly? We have this wonderful privilege, you and I, of getting to speak to the sharpest minds in this country. And I sit here and sometimes I just go, okay, I've got a few more questions. I look at the time and I go, we've got a certain bandwidth in their calendar that we're allowed to have, but it feels like it goes in a blink. We could ask a million more questions. And as you pointed out in that interview, we could continue to pepper with questions. But I love the takeaways from that podcast with Tim. There were so many in it, but what was your thought process in that one, Ben?
Well, the first one was how quickly the market may come back.
Yeah.
He's definitely countering what's been said by the banks and the forecasts that we're seeing in the media to sort of talk about a potential finding the bottom in early 2023. Like at the end of the day, he's a specialist in the property sector. So whenever Tim talks, I listen. So that says to me that, that's one of those ones. And the other couple of predictions, obviously Perth, well, I think we agree that that's going to be a very robust market. And I also suspect in terms of the unit market story that he was talking about, not necessarily buying the new stuff, but looking at the medium and that sort of density stuff in the right markets, he's bullish on that potentially being a short-term outperform as well. So there you go. When Tim talks, we listen.
Well, he definitely listens. So my takeaways were long-term trend is definitely up. That's been confirmed by every conversation we've ever had about playing the long game. Most are not affected by value fluctuations. Like we are affected in our gut, Ben, and in our wealth effect feeling, but we're generally not directly affected by those fluctuations. You bank dollars, you don't bank percentages. So, and the report will reflect that. And the reporting is aggregated to a market, but you invest in a dwelling. And I think that's a key point that I want everyone to go away with, because whenever you get a bank economist making a prediction, they're talking about aggregated data and they're talking about sensitivity analysis. What happens if it only drops this amount? What happens if it only drops this amount? What happens if it, and quite often it's only reported by the very bottom sensitivity analysis that they do. And my last thing is, if you wish for lower prices, Ben, it can come at a cost, because with interest rates going up, is it really cheaper? Is it really cheaper? You paid it maybe a little bit less, but it's costing you. And where it matters most is, we've said it once, we've said it a million times, balance sheet fluctuations don't matter as much as cash flow fluctuations do. No. So
we're long-term investors predominantly. There's obviously always exceptions to the rule, but if you think about this, the long game is the game. Plan to become what you plan to become. Set up your plans for 20, 30, 40, in our case, 30, 40, 50-year returns is what we're looking for our clients. This data supports that thesis. We have data now at sort of 54, 55 years of record in our own data sets. And it's sort of evident in those data sets as well. So from our point of view, that's why we don't get caught up in the short-term situations and that we don't overthink the short term. And then ultimately gives us confidence to act when the market is a bit shaky.
Tim, thank you again for your contribution today. Our community will be forever in your debt. There were some wonderful insights. Hey, my life hack today, Ben, is understandably an extension of the conversation we had. But one of the things that I highlighted in that interview, and one of the things I want to re-highlight, is how to absorb negative property market news. And we kind of talked about it in the wrap-up there, but direct quote, therefore, a more direct impact from short-term changes in housing market conditions are felt by the small proportion of households that are considering a property purchase or sale. From year to year, only 4 to 6% of properties that are transacted. So another way of saying that, Ben, is that 94 to 96% of properties are not transacted. Therefore, 94 to 96% of the people are not directly affected by any noise. And if you go and have a look at the graph in the report, folks, if the general trend is up and you're holding it long enough, you won't materialize any of the fluctuations because you would have bought it low and sold it high if you held it for long enough.
Yep. So, Bryce, what you're saying is the house that I own in Copeland Street in Sydney, which may have, at the peak of the market, I could have got maybe a 1.8 as an unbelievable result. Now you're telling me I can only get maybe 1.6 for it. Does it really matter if I'm not going to be selling it for the next 20 years? No. In fact, I'm actually going to put a new roof on it. That's how committed to it I am in terms of a new. Yeah. So there you go. I mean, it just goes to show you that to us doesn't really matter. It'll come out in the wash when we land the planes later in life.
couches, our community of people, we have been trying to equip you to be able to absorb and bump through all of the headlines. We told you generalized commentary about property helps no one. You should be well and truly, if you've done a lap of our podcast, Ben, you should be well and truly equipped to cater for the noise that you are about to be have to endure over the coming months. Because if you're playing the long game, as this report has confirmed you should be, and for anyone who thinks, property doesn't double every 10 years, folks, it's aggregated at a higher level to take out the volatility that Tim was talking about. But I don't know anyone, Ben, who's ever bought Sydney. Do you? I don't know anyone who's ever bought Melbourne. I don't know anyone who's bought regional Queensland. So just
good question. Who around the world could buy Sydney? Maybe Bezos or...
Maybe Bezos.
Musk, but that would be about it.
So you don't buy Sydney, folks. You buy a property in a street in a localised suburb that has localised conditions. So there you go, mate. What's making property news?
Well, Bryce, the big news is that APRA must have been listening to us. The Council of Financial Regulators have come good and they've seen the error of their ways. And now we have the buffer rate being reduced.
Adjusted.
So that's the big news of the week in the property space. And it's going to mean, look, it's good news, right? Because it means that not only for future buyers to be able to borrow enough to get into their property, but secondly, for those people in potential mortgage jail, it'll hopefully increase their ability to be able to refinance to a better deal. So it's a really good news story for existing borrowers as well as for potential new buyers.
From mortgage jail to out on parole, that's good news, Ben, so they can actually get some more money. So very good. That is great news this week in what's making property news.
Short and sweet, mate. That's the way we love it. When the governments do the right thing and the regulators do the right thing, we move on. What's next? What else do we have to fix? Oh, that's right. All of the reforms that are going on in tenancy. Let's go after those next.
Mate, there's always something that's for next week. But for this week, that'll be fine. Thank you for that. Yeah. Mate, another guest in the bank. Good to hear the money story from Tim as well. Negative on the scale.
Negative. And then it was his wife who straightened him up. Good on you, Amanda. Thanks for helping out. And never look back. I mean, you know that story about going to the bowling club? Yeah. I think I've told that story before about how poor I was when I bought my first house at 23. I'd go to the bowling club to play bingo on the Friday night. And if I didn't win bingo, because there was a cash prize of $50 or whatever, then I wasn't going out, going home. But the glasses of beer were only $1.70 back in those days. Oh, so you'd have cheap beer and you'd play your bingo. And if you didn't win, and you could see the looks on all of the old people's faces when we come in and basically started playing. Yeah.
I know all the acronyms for bingo. My nana used to take me back in the, when I was growing up in the early 80s, mate, I used to fall asleep under the table and she'd have her feet on me and she'd be doing bingo and we'd get in the car and get home at 10 o'clock at night. It was...
well, we don't say many of those anymore, Bryce.
No, you can't say some of those that you can get away with in the 80s.
You know what you can do? 2 little ducks. So, 22, quack, quack. That's about the only one you could probably do.
11, you can't do 88. Don't touch those.
Bryce, no.
So anyone who's born in the 70s and went to bingo in the 80s, you'll know exactly what we mean. For the millennials, you go, you're too far out. You get on with it. So we should do that, man.
The millennials have already turned off, mate.
That's a fair point. Mate, until next week.
Knowledge is empowering, but only if you act on it.
See you next week, folks. Hey guys, Bryce here again. Just want to catch you before you go and let you know, if you're new to our community, there are a lot of episodes to catch up on, but it's really important that you start from the very beginning at episode number 1, because episode 1 through to 20 share all of the foundational pillars and frameworks that you need to know to get the best out of listening to this podcast. So I'd recommend that you start there, and the little tip is to maybe start on 1.5 speed. Now, for those of you that are time poor and don't have time to go back from the beginning, don't worry, we've got you covered as well, because we've created a binge guide that goes through all of the details and makes it easy for you to read and get up to speed very, very quickly. So if you go to thepropertycouch.com.au/fast track, you will be able to download that binge guide and you will be up to speed in no time. And whilst you're there, I've got a few extra goodies for you, because we have our top 5 frameworks that you'll learn on this podcast, as well as the Make Money Simple Again ebook, which will help you with the foundations of basic money management, so you'll have everything you need to succeed in building your own lifestyle design and getting the best out of this podcast. Now, just a reminder that anything that we cover on this podcast is not considered financial advice. We certainly recommend that you get your unique circumstances looked at by your individual advisor, and everything we talk about is just general in nature. But folks, I want to encourage you again to go to thepropertycouch.com.au/fast track, and you can go and get all those goodies and catch up right away.